Welcome to the deep dive. Today we're tackling something that really gets to the very heart of personal finance.
It really does.
We are diving deep into the source material that, it exposes the single biggest hurdle for the average investor.
And that's the idea of timing the market.
Exactly. That urge to wait for the perfect moment to, buy low and sell high. It feels so simple.
It feels like it should be the whole point of investing, right?
Yeah.
But what all of our source material shows, from these huge studies to behavioral finance reports, is that this quest, this dream, is, well, it's built into a really flawed idea.
The idea that we can actually predict what's going to happen next.
Exactly. So our mission today is to understand why. Why does emotion just sabotage our performance, and how can you flip that script by doing the exact opposite of what feels natural?
And we've got the data to back this up. Research from major financial firms, decades of tracking data, it's all here. We're going to prove, really, mathematically, that just being in the market is the way to go. Now, we always have to say this. Take these ideas, listen to what the sources say, but you have to use your own brain.
Of course.
This is purely educational. It is not personalized financial advice. Your goals, your situation, that's all on you.
Exactly. Let's just jump right in.
Okay, so let's unpack this. I mean, everyone wants to make that perfect trade. But what is the real impact of trying to predict those entry and exit points?
Well, it's painful. A good place to start is with John Bogle. His words kind of echo through all our sources.
What did he say?
He put it very plainly. The average investor does worse than the market because they enter and exit under the effect of emotion. And that's the whole story right there.
It's this total disconnect between what we want to do, buy low, sell high, and what we actually end up doing.
It's the complete opposite, really. When you look at the cash flows, it's all driven by euphoria and fear.
So when the market is flying high,
that's when the FOMO, the fear of missing out, kicks in. Everyone's talking about it, the news is all positive, and people finally jump in.
So they're buying when prices are already high.
Exactly. They're driven by euphoria. They're terrified the party's going to end without them.
And then when things go south, when there's a correction,
panic. That same urgency pushes them to sell low, just to make the pain stop. They basically guarantee a loss.
So they exit at the absolute bottom of the cycle.
The worst possible time.
Right.
And the consequences, they go way beyond just the money you lose. I mean, our sources really stress the hidden costs here.
Like what? The stress of it all?
The permanent, exhausting stress. You're constantly checking the news, trying to guess the next big move.
That sounds like a full-time job. And a pretty bad one, considering the results.
It is. And this fear of being wrong, it can be paralyzing. People either churn their accounts constantly or they just do nothing. They're so scared of making the wrong move that they sit on the sidelines and miss out completely.
So the emotion itself becomes the real enemy here.
It sabotages performance much more surely than any crisis ever could.
Okay, so the emotional cost is clear. But let's talk numbers. I mean, how much are we really losing by playing this timing game? Because some of the data we have is just, well, it's staggering.
This is where it gets really concrete. We have to look at the math. There's a critical study from J.P. Morgan Asset Management. They looked at the S&P 500 over 20 years.
And the whole thing boils down to just a handful of days.
A tiny fraction of days. The study found that if an investor missed just the 10 best performing days over that entire 2-decade period, their total return was divided by 2.
Cut in half. For missing 10 days out of, 5,000 trading days?
Exactly. You miss 10 days, you lose 50% of your potential gains.
I think that's something people just don't get. They think, oh, I'll sit out for a bit, it'll even out. But these days are, totally random.
Completely unpredictable. The best days often pop up right after the worst days, during these periods of crazy volatility.
So if you're waiting on the sidelines for things to calm down,
you've already missed it. You've missed the explosive day that delivers a huge chunk of the decade's gains. This isn't just a theory, it's the mathematical reality.
And that one statistic, that should be enough to end the argument right there. But we have more.
Oh, we do.
We have the work from Dalbar Inc., their 2024 quantitative analysis of investor behavior. This one is so important because it compares what the market did with what people actually earned.
That's the key. It's a 20-year study. It looks at the actual realized returns of individual investors in mutual funds and puts them right up against the S&P 500.
And the results are not pretty for the market timers.
They're damning. The conclusion is that over that 20-year period, the S&P 500 averaged around 9 to 10% a year.
Pretty standard long-term return.
Right. But the average individual investor, the one trying to time the market, They earned an average return of only about 4 to 5%.
That's a 5-point gap
Yeah.
every single year, compounded.
Yep.
Let's put that in real money terms. Say two people start with $50,000. Investor A just buys an index fund and leaves it alone. Investor B tries to time the market and gets that lower return.
The difference is life-changing. After 20 years, adding maybe $500 a month, Investor A, the passive one, has well over $500,000.
In Investor B.
Investor B, the timer, barely gets over $250,000. That gap doesn't just cut their return in half. It basically destroys their chances at financial independence.
It completely changes their retirement. And the sources are so clear that the reason for this gap is those emotional timing decisions. It's buying high and selling low over and over again.
And Dalbar actually breaks it down. They pinpoint the specific psychological triggers, the behavioral biases that cause this.
Let's go through those, because if you can spot them in yourself, you can stop them. The first one is loss aversion.
Yeah, this is a powerful one. It's that human instinct where the pain of a loss feels like twice as bad as the pleasure of an equal gain.
So when the market drops, that feeling is so intense
that you just want it to stop. So you sell. You turn a temporary dip into a permanent, real loss.
Okay, the second one is the herd effect. This is just following the crowd.
Yep. It's when you see everyone else rushing into something and you just follow along without really thinking about it. Yeah. A stock or a sector gets hot in the media.
And everyone piles in.
They're not looking at the fundamentals. They're just buying because it feels safe, because everyone's doing it.
And the third one, which kind of fuels the other two, is overconfidence.
This is the big one. It's the bias that makes you think I'm smarter than the market. I could see the turn coming before anyone else.
When even the pros, the people who do this for a living, can't reliably do that.
They can't. The sources are unanimous on this. Predicting short-term moves is basically mission impossible.
So these biases, they all feed into this classic behavioral cycle. It's like a roadmap of how the average investor messes up.
It is. It shows the emotional journey of a bull market. And it doesn't start with everyone being excited.
No, it starts quietly. So walk us through it. The market starts to rise. Where is the average person?
They are in what's called the gestation phase. The smart money, the big institutions, they're buying. But the public, they're skeptical. They're in denial.
Thinking, oh, this won't last. Or they're still hurt from the last crash.
Exactly. They're waiting for a better time to get in, so they miss the easy early gains.
And then the market really starts to take off.
And we move into the euphoria phase. Now the media is all over it. The herd effect kicks in, and the general public rushes in late.
Pushed by that FOMO we talked about.
Totally. This phase is all about illusion and greed. The belief that this time is different, that it'll go up forever.
And this is where the overconfidence peaks, right? People start doing crazy things.
Absolutely. They start taking huge risks. They use credit. They drain their savings. They pile into just one or two hot stocks. They're buying at the absolute peak.
And then the pop. The market corrects.
And that denial from the beginning turns into pure fear. At first, they hope it's a blip, but as it keeps dropping, the fear gets worse.
Until they can't take it anymore.
And that's capitulation. They sell everything right at the bottom. They lock in their losses just to escape the pain.
So they've bought at the top and sold at the bottom. The perfect recipe for disaster.
And the cycle is doomed to repeat.
Yeah.
Because now that investor is traumatized, they're filled with despair, they sit on the sidelines in cash.
And they refuse to get back in until the market is flying high again and the media is euphoric and they jump in late all over again.
It's a vicious cycle. And understanding it shows you that if you follow your gut, you are almost guaranteed to fail long term.
Okay. So this entire deep dive has painted a very, very clear picture. We can't predict the market. Trying to do it creates this massive performance gap. So what's the takeaway? I mean, what does all this mean for someone listening right now?
The takeaway from all the sources is, well, it's incredibly simple. And for a lot of people, it's revolutionary. Time spent in the market is fundamentally more important than the moment of entry.
So it's not about being a brilliant timer.
Not at all. It's about regularity. It's about patience. Those are far more profitable than trying to be a predictor. It's better to just be invested than to try to guess.
So by being consistently invested, even if you buy at a high point sometimes,
you're guaranteed to be there for every single one of those unpredictable, best-performing days. By automating it, you remove your emotions from the equation. You let time and compounding do all the heavy lifting for you.
You realize the biggest threat isn't a market crash. It's your own emotional reaction to it.
That is the goal.
And that right there, that's freedom. It frees you from the stress of checking your phone every 5 minutes, of chasing headlines. You don't have to be a genius. You just have to be patient.
It lets you shift all that mental energy to things that actually matter.
So we want to leave you with a thought that really builds on all this. If the data proves that time beats timing, does that mean your real job isn't to be a portfolio manager, but to just maximize how much you save and simplify where you put it? If you stop trying to beat the market every day, what could you start focusing on instead that truly builds your foundation for long-term independence? A great question to think about. If this deep dive has given you a clear, actionable mindset shift for your long-term goals, we'd really appreciate a like and a subscription to the channel.
It helps a lot.
And if this content has inspired you to move toward that idea of buying back your own freedom through smart, consistent investing, please comment below with the word freedom. We'll see you on the next deep dive.